So you had earnings out last week. And one thing I think you could start with us, at least here at Bloomberg on, your bank is a bit different from some of the other major banks in Europe, for that matter, in the United States, in your diversification, geographically, as well as lines of business. Explain that to us.
Sure, it's great to be here, David. Thanks for inviting me. So we are different. We are actually one of the largest banks in the world by number of customers, 155 million. We are the #1 bank in Latin America. We're big in the U.S. We are an at-scale auto lender here in the U.S. So we are European, but actually more than half our earnings are coming from the Americas. So we're not the same as other European banks. I mean, we're very different.
And how is that helping you, or how could it be holding you back?
Well, we think it helps us. So being an at-scale player is important in today's, very competitive and platform economy. So being able to service customers in different countries. Our business model is simple. We do retail, commercial banking. We have a geographic footprint, which is Europe and the Americas. We're active in 9 countries, so we're not in as many countries as our peers with a simple business model.
Here in the United States, particularly in New York, money center banks, we spend a lot of time looking at trading activity. Are they up? Are they down? How much of your business is from trading?
Very little, actually. That's one of our strong points. So if you look at our earnings, most of 95% is net interest income and fees. Our strategy is to continue growing more on the fee side. We're growing our revenues, our top line over the last few years. So we deliver growth in a very stable, or more stable than our peers, because we have very little market and trading activity. It's customers.
You mentioned that a lot of your business is retail. Retail business tends to be somewhat sensitive to interest rates. We have the Fed decision that we're all waiting for on Wednesday here. What's going on from your point of view, given the fact that you're both in Europe, big in Europe, but also in the Americas? What's going on in terms of rate increases and inflation?
So, the high-level message on Santander, and you saw that in the first quarter, is that we do better when things are complicated, when there is an uncertain environment, because the business diversification and the geographic diversification helps us to have more, I'd say, more stable, predictable through-the-cycle earnings. With higher rates, we're going to be more profitable. You have not seen a lot of that yet, because our biggest balance sheet is in euros, even though our profits are coming from the Americas. So you will see higher net interest income in Europe as euro rates go up.
We feel at this point that we have some sense of what the Federal Reserve is likely to do, at least this Wednesday, and even maybe going out. Do you have that sort of sense with respect to the ECB?
Well, the ECB is going to raise rates at some point. I think they've been very clear about that. Inflation in Europe is, depending on the country, somewhere between 7 to 9%. So there will be an increase in rates. And central banks, have a narrow path to go down without harming the economy, but also neutralizing inflation, which is having a negative effect on consumers. But net rates will go up.
Quite apart from monetary policy in the central banks, we now have a war in Ukraine. You know it well. It's closer to you in Spain than it is to us in New York. How is that affecting your business?
So, above all, it's a humanitarian crisis and a refugee crisis that we have not seen in many decades. We actually have a bank in Poland, so our team has been very active. We have a branch right next to the border. So we've been helping refugees travel to different countries in Europe. We are helping them, get cash, working with the UN agencies on that. It is going to have a very different effect on different areas. So our base plan is that, and our projection is Europe will grow less. So it's not likely Europe goes into a recession the next 12 months. We're seeing in our business strong consumer demand if you compare it to last year. We see the U.S. as being moderately affected, so not as much as Europe. And we see Latin America as being neutral to positive because they're big commodity exporters.
Well, and that's important. You go back to the diversification because of Brazil, I assume. That helps you in Brazil?
It helps us in Brazil, but also Mexico. Mexico will benefit from this is not so much the war, but partly also the war. It's the nearshoring, having the supply chain closer to home. That, I think, is a plus for Mexico. And, of course, the commodities benefits Brazil, but also Chile.
I want to talk about Mexico in a moment, but before that, in general, you get to talk to a lot of people, individuals and corporations in various places around the world. Do you have any sense of pressures they may be feeling as a secondary effect of the war, whether it's from supply chain problems, which are not just Ukraine, but also China related? Are they feeling more stress in their business?
So, what happened during COVID is, and of course it's not equal across the board, but both Europe and the US had a big amount of savings accumulated. So the numbers are between 1 trillion in Europe to 2.5 trillion in the US. So the consumer is in a pretty good state for now. Obviously, they're beginning to suffer the increase in energy prices more in Europe. But we see still, if you compare year on year, the consumer is strong, including in the US, also in Europe. Where we see a bit of weakness is in the investment from corporates. So I think that's where we have not seen a pickup as we would expect. But we believe that should happen because there's a bigger demand to have that supply chain closer to home. Energy companies having to finance working capital, and that is also a bigger demand for credit. So I'd say consumer strong, no signs of weakness yet. On the corporate and commercial side, not as strong as we would like.
Tell us about your investment at Santander, and specifically Mexico. You mentioned already. You have indicated in the past you are interested in expanding your business in Mexico, maybe even buying the city retail business. Where are you on that?
So Mexico is a growth engine for Santander. It's a business that on the retail side has been gaining market share every month for the last 22 months, a return on tangible equity adjusted for 12% capital of 30%. We've built an auto business from scratch to about 14% market share. So there's a lot of organic growth for us in Mexico without buying Banamex. Having said that, and I want to be very clear, we will only buy Banamex if we can pay cash. We would not issue shares at the group, nor at the Mexican subsidiary level. We can keep our CET1 at 12% or above. And very important, we keep the dividend policy we have announced of 40% payout to our shareholders.
Okay, that was very clear. If there were a deal, how it would be done. But I want to come back, just double back a moment. You want to grow in Mexico. At this point, do you believe you can achieve all your goals through organic growth?
Yes.
You don't have to do a deal?
No.
Let's talk about the United States. You're also expanding the United States.
Yes.
You have perhaps a more extensive business in the United States than some Americans might understand. Once again, organic, or are you also considering going beyond organic growth to acquisitions? So,
as a matter of fact, last year we invested $3 billion into the U.S. We bought out the minorities at Santander Consumer. We have a very profitable business and a growing business in the U.S. The U.S. was Santander's #1 country by profits in 21. So we have a profitable business, it's growing. The difference with other international banks that have left is we have an at-scale auto lender. So we can originate assets at scale, and we can fund them with core retail deposits through our banking operation. What we're now working on is to make that business more tech-enabled, more efficient, more customer-friendly, better experience. And that is where we see the growth, simplification of that deposit-gathering business. And, of course, the corporate investment bank and the wealth management.
You mentioned the auto lending in the United States. You also, I know, are very big in mortgages, not just in the United States, but in the UK and Spain, I believe. You're quite big in it. At this point, are you considering taking bigger loan loss provisions? I know, for example, ING, your Dutch counterpart, is doing that right now. Are you seeing some weakness on the credit side?
No, we're not. So, our footprint is quite diversified. And in Europe, we're seeing very, lower cost of risk than we had last year. We're a big mortgage lender in the UK and Spain, but these are prime mortgages, low loan to value, so very low risk portfolio in terms of the mortgage lending.